Hi there folks, welcome to another clip here on my YouTube channel. Before we get started with today's topic, the euro-US dollar, I would simply like to draw your attention to this kind of a channel right here. There is a red button here at the YouTube platform and it's quite easy to hit to subscribe that one and you will be a member of it. Very much appreciated if you do so. On top of that, it's very much appreciated if you leave some thumbs up for this clip as well. Alright, let's get started with the chart technical analysis right now.
Technical picture. As you can see, this is a daily picture and you see the euro-US dollar rate forex bid as shown right here. That's a chart technical software from guidance, as you can see right down here. Alright, there is a Fibonacci set up and that starting point, the 100% Fib is at 114.949. And the 0 point is at the last low, so the multi-year low at 108.060. So these two levels combined as usual with a couple of Fibonacci retracements to be shown here with the yellow lines, are giving you a little bit of a hint where the journey is going to or possibly going to. So the first reaction, the first move back into that neckline territory here from the 111.20s from the last low here, already been tested after the Federal Reserve, the FOMC rate statement last week. So we went up there in direction of the 111.20s to be tested, a little bit above that, and snapped back down here to retest at 110.69.2 level, which is a 38.2 Fibonacci retracement from the retracement areas shown here. So the possible targets to the upside, the next levels to the upside would be a retest of that 111.20 neckline and a possible, let's say reach out for that last neckline here at 112.30s, 112.20s from the lows, and in combination possibly with that 61.8 level here from 112.31.7, quite close to that blue line, which is the 100 EMA, and the red line, the 200 EMA, as you can see right above here, if you just check that one here. All right, on top of that, you see the relative strength index is still in neutral territory, 47.5 at the closing point at the weekend. And let's have a look at the fundamentals right now.
Okay, let's get into some more details and some stuff like Fed projections. On top of that, economical data, and not to forget this kind of, let's say, crisis mode we still face from the geopolitical side regarding Ukraine-Russia war in Eastern Europe. Okay, let's start with a major topic, the euro-US dollar rate. Talking about that Fed rate hike, or let's better say that FOMC rate hike from Wednesday. So the first 25 basis points and the first hike since 2018. And the Fed, so did Mr. Powell, talked about hiking every meeting until the rest of the year. So that means if you count that with the already 25 basis points, you will be having 7 hiking sessions until the rest of the year. So in addition, that might be something like a median projection from the target rate of 1.9% in the year 2020. The Fed projections tell us we will have something like 2.8% regarding the target rate in the year of 23. So there is a lot of room for the next 4 rate hikes in the next year. Whatever is going to be in effect, 100% in effect, the current status of the US economy might be getting some scratches just because of the current geopolitical issues and far more from the energy policy and from the energy prices, commodity prices we face right now, not even in the US, we face in Europe here as well. On top of that, we need to say there is a lot of room for a possible lower GDP outcome in the year 22. And if you just check the Fed projections, you will realize that this is kind of a major topic, even a major topic for the euro-US dollar rate. Because the Fed in December 21 said that the possible GDP outcome in 22 would be something around 4.0%. Now they revised that down to 2.8%. So that's a huge drop. And on top of that, in the following years, this is not the same. They said something like in 21 before. So the steam of the US economy is losing some ground from step by step to the next month to the end of the year. On top, always on top of that, comes economical data. Unemployment rate, all the NFP data, producer prices, absolutely not to forget inflation, so the CPI numbers. So looking into the rest of the year, this is the major topic. This is the major driver of the euro-US dollar rate. Not only our kind of CPI data here in Europe is worse, no, the US CPI data is even more worse. This is nothing like to be happy about. It's the other way around. It's kind of scary right now. So if you check out the CPI data from the US, February 2022, so we got 7.9% inflation rate on a 12-month basis. It's scary. You all know that this is the worst number since 1981, July, they said. And regarding producer prices on a 12-month basis, we got already a hit of the 10% marker. So they jumped 10% on a 12-month basis. Everything is going to get more expensive. And the more expensive it gets, the less money the consumer has to possibly buy something else and to help the economy to grow. Because the US consumer is about 65 to 68% of the GDP of the US. So if the consumer, the US consumer, is on strike or is not able to buy more, then the US economy in that case has a problem. It will grow less. And the more it grows less, the more problems the GDP faces, and the more problems the dollar faces again. Because this kind of a US dollar bull run might be at its last leg. So I don't think that we see all these kind of levels like a parity or even sub-parity levels a couple of investment banks talked about, or that we see something like parity levels just because of the security. The US is a safe haven play, US dollar is a safe haven play. This is altogether something about stability, of course, about inflation rates, about real interest rates, and all that kind of stuff right now is the problem that we will face more negative yield rates and more negative yield in the US than we face in the Eurozone, for example. It's still the way. Maybe this is going to be different in 2 months or even 1 month after we see that crazy inflation numbers because of energy price inflations. This is something else. Analysis is always something moving. It could be that in 1 week or in 2 weeks or in 1 month the situation is completely different. All right, all these kind of things together is something like a conclusion that we might see a little bit of a reversal in direction of the 114 levels again. This is nothing hammered in stone. This is nothing which will happen in the next week, but it could be that we already saw the low with the 108.06. All right, it is Sunday. Hopefully you guys had a great and a fantastic sunny weekend and relaxed, and you'll be happy about the markets about to start, and I wish you the best, a pipful week, lots of winners, and not to forget, health, luck, stability in your portfolio. See you next time. Thank you for your attention and for your time. Bye.